A welcome to all those who have joined the mailing list and all the readers, to this 35th post of investing, not rocket science. Investing doesn't have to be rocket science, this is our non-expert guide to portfolio management. In the last 5 months, this free blog has added 900 plus readers to our mailing list. A quick recap of this blog series so far. In the first post, I defined a basic portfolio framework. The objective of this $1 million portfolio is beat inflation and an equity index. The investment style presented here is active portfolio management, without the use of leverage and a time horizon greater than 5 years. The benchmark index is the MSCI ACWI Investable Market Index. Typically, there are 2 posts a week, which includes details of the portfolio and actionable evaluations. From posts 2 onwards, I have evaluated 71 stocks and 4 potential bond additions. The portfolio is long 15 stocks, 1 bond and short 1 stock. Posts 21 to 27 were focused on the Q1 2023 earnings announcements, particularly of stocks in the portfolio and in the watch list. In this post, we will look at the key highlights in H1 2023 and what one could expect in the financial markets for the rest of the year. This is a snapshot of the performance among various asset classes. Key highlights from H1 2023. U.S. headline inflation cools to 4%. Apple hits $3 trillion market cap, becomes the largest public company in the world. U.S. crude prices falls -35% in 1 year. Nasdaq 100 rises 39% YTD, best first half since 1983. Yen falls -10% against USD this year. 10-year U.S. Treasuries flat for the year, 2-year at 4.9%. ECB raises interest rates to 4%. Bank of England raises interest rates to 5%. Inflation peaked mid-last year in the U.S. Headline CPI has fallen from a peak of 9.1% in July 2022 to 4% in May 2023. Last year this time, the expectation was for the Fed to take a less aggressive stance with interest rates if inflation cools. However, core inflation remains a concern, peaking at 6.6% in September 2022. It remains at 5.3% in May 2023. The Fed continues to raise interest rates. According to the June FOMC guidance, the expectation is for 2 more interest rate hikes this year, taking rates to a range of 5.5% to 5.75%. In the EU, CPI peaked in October last year at 10.6% and has fallen to 6.1% in May this year. Core CPI continued to rise until March this year, and in the most recent reading, May 2023, was at 5.3% YOY. The ECB began raising interest rates in H2 2022, from 0% to 4% currently. According to guidance from the June ECB monetary policy meeting, it is expected to continue raising interest rates this year. In the UK, the fight against inflation is progressing slower than anticipated. Last year, CPI peaked at 11.1% in October. The recent reading for May 2023 remained unchanged from April 2023 at 8.7%. Core inflation surprised to the upside in May 2023, rising to 7.1% from 6.8% in April 2023. The Bank of England has raised interest rates to 5% this year, with more rate increases expected.
In China, headline inflation was up 0.2 in May 2023 from a 0.1% rise in April. Inflation averaged 2% in 2022, and so far, this year, inflation has averaged a 0.8% rise. Data shows deflationary trend in China on a month-on-month basis, with May 2023 at -0.2% from -0.1% in April and -0.3% MOM in February. The People's Bank of China has reduced prime lending rates by 10 basis points to 3.55%. The previous rate cut was in August 2022, a 5 basis point cut to 3.65%. Last year, oil price was the main driver of inflation. This year, a fall in oil price has the largest downward contribution to headline inflation, except for UK, which seems to lag the US and EU. Core inflation continues to remain persistent. Central banks are likely near the end of interest rate hikes and may need to keep them at these levels, barring a recession, to bring inflation down to their 2% goal by 2025, while trying to avoid doing too much or too little. Bond funds have underperformed expectations in the last 18 months. Developed markets government bonds with 1 to 3 year maturities may present an opportunity for portfolio allocation in H2 2023 and in 2024. Despite a fall in real wages, the EU and UK narrowly dodged a recession. We see uneven growth in China due to COVID lockdowns, and in the US the anticipated recession didn't show up. In the US, the job market remains tight. Unemployment doesn't appear to be a concern given the regular stream of job openings, and consumer spending continues to remain stable despite a housing market correction. The Purchasing Managers' Index, which are considered a leading indicator to GDP, shows weakness. Industrial production shows weakness as well. The recent banking crisis in the US is expected to have tightened credit conditions. Along with higher interest rates compared to a year ago, all of these factors may have negative impact on GDP growth. However, the exact lag time between credit conditions, economic indicators, and actual GDP remains uncertain. Corporate earnings in the US. According to data from Refinitiv, revenues in Q2 2023 are expected to decline -0.6% and earnings is expected to decline -7.8% from the same quarter last year. In the previous quarter, reported earnings did surprise on the upside. Estimates for corporate earnings for the S&P 500 were revised downwards from plus 1.4% in Jan this year to minus 5.1% in April. Actual earnings grew plus 0.1%, beating estimates. An earnings beat this quarter may continue to fuel the bull run in equities. The S&P 500 index is currently trading at a forward earnings of 19 PE. Corporate earnings in Europe. According to data from Refinitiv, revenues in Q2 2023 are expected to decline -6.5% and earnings is expected to decline -7.4% from the same quarter last year. Like in the US, corporate earnings in Q1 2023 did surprise on the upside. Estimates for corporate earnings for the Stoxx 600 were revised downwards from plus 1% in January 2023 to -3% in April. Actual earnings grew plus 11% YOY in Q1 23, beating estimates by a wide margin. The index is currently trading at a forward earnings of 12 PE. US fund flows. Large blended funds have seen large net inflows in H2 2021 and in 2022. Net inflows continued this year, although at a much lower pace. The S&P 500 is considered a large blended index. Large growth funds have seen net outflows since H2 2021. The Nasdaq 100 is considered a large growth index. Japan, Europe and UK funds, which saw net outflows last year, have seen inflows this year. So have diversified emerging market funds. China sees net inflows this year, although at a much lower pace than H2 2021 and 2022. Market breadth refers to the participation of stocks in the movement of the index. Both the S&P 500 and the Nasdaq 100 are currently above their 50-day moving averages. These charts provide information on percentage of component stocks that are also above their respective 50 DMAs. What is observed is that the rise in the indices this year shows similar participation trends when compared to the market top in 2021. With that, we come to the end of this part of the series, Investing Not Rocket Science. None of this is expert advice. Please refer to the terms on our website, www.claritech.app. Thank you for your time. See you in the next video.